Hi guys, it's Marissa here and welcome to another episode of Rise High TV. We're doing a very special episode today all about the new South Australian land tax changes, and I've got Adrian Cartland from Cartland Law here to help us out with the segment today. He's an expert in this area, so we're going to really drill into it. This has definitely been an area of a lot of great interest, I would say. You know, we've been inundated with questions in the lead up to today's segment, and I know that a lot of people are really interested in understanding more about exactly what the legislation means and how it's going to work for their personal situation. So I'm hoping that today we can go through the new legislation in a fair bit of detail to hopefully leave you feeling confident, understanding exactly what it means and how you can maybe apply that to your personal situation. We're going to be going through some real life scenarios of some of our clients who have been kind enough to agree to let us use their scenarios for today's Facebook Live segment. And we're hoping that, you know, you'll leave this segment feeling really confident that you know what the legislation means, you know, where to go for more information, and you know where to go from here. And you also feel empowered to know what to do for future investment properties that you want to purchase to add to your portfolio. So that's what we're going to go through today. We would really love to have your comments and feedback throughout the segment. So if you do have questions as we go, please put them in the comment section. We will anticipate to answer every question that we can today as well as we can. Obviously the legislation is very new, so there are still things that are being sought through, but we're going to try and unravel as much of it as possible today.
Well, really the big unknown is that how Revenue SA will actually administer some of these things. So there's one thing to look at the black letter law and go, this is what the rules are, and we can go through that. Other things, we can base judgments on our experience with dealing with Revenue SA. I've been dealing with them for decades, and so we can say, this is what they've done in the past, this is what they might do, here are some ways they might treat this. So these are kind of administrative things that they're really your edge cases for your core material of, like, this is how much tax we're going to pay, this is how we can structure things. There's actually, one of the good things is that we have now a lot of certainty. So the last time I was here, I was saying, well, the problem is we don't know what's going to happen. Like, they've made these announcements, they've proposed this, and I said, well, are we going to follow the New South Wales terrible model or the Victorian less bad model? And we're in Victoria's model now, and and one of the good things is there's certainty, and I would say that now that we know what things are for certain, we can actually plan it. And so I think the only person that should be afraid out of this is really the person that puts their head in the sand and doesn't do anything. Exactly. So if you don't pay attention for the next 18 months, like, this can really sting you, bite you in the bum. But
there is time to get on top of it.
So with some planning, for some people there's going to be a bit of a speed bump. It's not going to be great, but for other people, if you've got larger land holdings, this can be a win. Also, for other people, this can be a planning opportunity. So, in fact, I've had some clients who are paying less land tax now than they did previously. So that's a win.
So I think that's the thing. I think you hit the nail on the head. Is that there has been such a long period of uncertainty, and the proposed rules have changed so many times over the course of the discussion about land tax in SA that I think now a lot of people are in a state of confusion as to what exactly the rules are, and there are a lot of myths out there about what the rules mean. So we're going to try and address all of those myths today and really sort of help you to understand what they are, because I must admit, I've obviously been very publicly fighting against the aggregation changes with land tax, and whilst I'm still disappointed that we didn't win that aggregation fight, I think that our lobbying and the hard work that myself and a lot of other people did in fighting that legislation meant that we've ended up in a much better position than what we could have ended up with.
Definitely. Like one of the things that I was talking about last time I was here, I said, we could end up with like terrible trust provisions and like we have in New South Wales, and that was one of the things that changed from the draft legislation to the new legislation, and so like that and a number of other changes have really made these things like manageable, and so and in particular, there's a transitional period as well. So no one's going to, we're not going to like fall off a cliff. No one's going to go, from zero to like something massive, like unless they already have a huge land holding.
Because it's not only the rules that have softened, but it's also the rates that have come down and the thresholds that have been lifted.
Correct.
So I guess, one of the things that I want to express during this segment is that it's not as bad as we think it's going to be. And now that I've had chance to sit down and do the calculations and go through it for specific customer examples, I'm actually like, okay, in some situations, people's land tax bills are increasing, but it's nowhere near as problematic or terrible as what we initially anticipated it would be. So I think that hopefully people can see that there is light at the end of the tunnel. And like Adrian said, we do have time to plan, and there has been a little bit of grandfathering built into the legislation that we'll talk through as we go through. So what we might just start with, Adrian, just to sort of give people a general overview, is just to, a basic understanding of what the legislation currently is and just what aggregation means. And then what we're going to do is we're going to drill down into different types of ownership to, really understand each of those a bit closer. Before we do that, I'll do some shout outs. We've got a few people that have tuned in. Hi Ray, hi Ricardo, Trevor, Julian, Luke, Rue, Priya. Thanks for tuning in, guys. We'd love to hear your comments or questions, so write them in the text box below. So what we're going to do is just a brief overview of what is the legislation, what does it mean, and then we'll drill down into the individual specific ownership groups.
So at present, land tax is imposed on taxpayers, and so what happens is that there's the Act pulls out people and says you are a taxpayer, and this is one unit of taxpayers. So one unit of taxpayers might be a husband, might be a wife, a third unit might be the husband and the wife together, and then a fourth one might be a trust that they have, and a fifth one might be a company that they have, and then a sixth one might be the husband plus the trust, and then a seventh one might be the wife plus the company. And so you could create a whole bunch of different taxpayers out of there based on the ownership. Now, over the years, there's been a number of changes because people have created lots of new taxpayers or lots of new ownership identities. 20 years ago, it was really commonplace to, like, the default structuring would be you'd have something 99% in a trust, 1% owned by a person. And then they got rid of the minor holding, like anything less than 5% is automatically disregarded. Then there's been a lot of attacks over the last 5-7 years on whether a trust is different from another trust. So they've been chipping away at this, and Revenue USA have been winning some battles and losing some battles. And so they're feeling like they're losing, and so they've done so now that we've had this restructure. And so what things happen now, like the fundamental, fundamental, like the overarching view of how it's supposed to work is it's supposed to drill through whatever entity owns it and drill it down to a particular person. So, like in that example, there's a husband and a wife and a trust and a company. It's going to look through and say,
who is the individual that ultimately controls it and ultimately it belongs to,
and give it to them. Yeah, and so you could say, well,
which is aggregation.
Yeah, well, and so it means instead of now having 7 different properties, 7 different taxpayers, you can only have 2, really. Yeah. And then so that's the first part. And so for something like a company, like just say the shares are held by the husband and the wife, it's going to be it would be 50% of the property would sort of flow through. Like a hypothetical ownership flows through to the husband and 50% down to the wife. The property that the husband and the wife have in their own names, like jointly, is going to be like cut in half. So the husband, it's deemed that he owns half, and The wife deemed that she owns half. Now,
so I guess in like simplistic terms, the government is trying to create a situation where you're now unable to use different ownership structures to reduce your land tax.
yeah.
Whereas in the past that has been possible.
Totally.
You know, you have been able to use different ownership structures to reduce your land tax.
Mm-hmm.
Moving forward, that's going to be more difficult.
Well, they're attempting to make it more difficult.
They're attempting to make it. Whether they have succeeded or not is yet to be determined. But I guess what it is saying is that there are different rules around those things. But aggregation is the key theme of the legislation now in terms of, like you said, identifying the land holdings down to an individual.
Yep, and they're going to say, and so the idea is that they're going to find these, husband and wife own these various properties and look through the corporate entities that they have. Now, there's a bit of mechanisms the way that happens. I don't think it's necessary to go through the mechanisms of assessing at the trust level and then reassessing at the lower level. That's a bit more, we can go into that if someone really wants some technical stuff. But just like the look through is the general summary of how it works. But you can also not look through trusts. And if you don't look through them, then there's going to be a surcharge rate. So we'll go through that in a bit more detail in a minute when we talk about trusts. But what I wanted to also reflect on is that we have uploaded the land tax rate tables to this post in the comments below. So what that will show you is that will show you what the current land tax rates are and what the land tax rates will be in the coming years. Mm-hmm. One thing that has been a bit of a win in terms of fighting these changes has been that we have been able to achieve significant rate cuts with land tax rates, and we also have been able to achieve increases in the threshold rates across all of the bands. So what you'll actually see is that over the coming 3 years, the land tax rates go down and the thresholds go up. So you might actually find that the land tax that you pay in 2021 financial year will actually be more expensive than the land tax that you pay in 2023 based on what's happening with the rates. So I've put those rate tables up on the comment section so you can have a look at those as we go through. We'll be referring to those rate tables when we go through the individual client scenarios so that you can understand where we're going. The other complexity in this is that there's an ex gratia relief over the next 3 years. So for investors who have between say 2,500 to about 100,000 in land tax, and if their land tax increases, they can get 50% or 30% of it back, like 50% the first year or 30% the next year.
So they're the relief.
That's the relief,
once again, we'll be going through. Adrian's so excited about this topic.
I'm just jumping ahead. Oh, okay. I'm trying to.
So we are going to go through the relief packages that are available because that was another win out of the lobbying.
Yeah,
that we were able to get some relief for taxpayers who are going to experience a big increase. I can see we've had a question come through from Amanda and we're going to address that in a minute. So let's move on to individuals because individuals who own property in their individual name. The first thing I want to say here is that a lot of people have asked if you've got a husband and a wife and they both individually own investment properties in their own individual names, there is a myth out there that those properties will be aggregated between the husband and wife.
Yeah, no, that's not right.
So that's not right.
No, it's only when they own them jointly. So if the husband owns 50% and the wife owns 50%, then those two will be aggregated. Well, rather just say the husband owns Blackacre and the wife owns Whiteacre, and then they own 50% of Greenacre. Greenacre is going to go 50% to the husband and be aggregated with Blackacre. Greenacre is going to go 50% to the wife and be aggregated with Whiteacre.
Yeah, exactly. So that's definitely something that we can. So that should hopefully ease a few nerves because if you've got some property owned by the husband, some property owned by the wife, they will still be continued to be treated separately. Let's go to Amanda's question. Amanda's asked, what does it mean for me as we pay no land tax now? We have 2 properties together, 1 on my own, 3 in total. Will we pay land tax? We have no trust. So with this question, it's hard to know it's hard to know what the answer to that is without knowing what the land values of those properties are.
Exactly.
Would you agree,
Yeah,
Adrian?
agree.
So if you pay no land tax now, but you have two properties together, you know, could you say that the properties that they own together now, the 50% of that would be aggregated with the property that Amanda owns in her own?
So we're assuming these are all rental properties, and so what you'd say is the two properties together, 50% of the value. So we're going to have to assume. You make some assumptions here.
Yeah.
So given that you have two properties together and you're not paying land tax on them, the land value of those two properties must be worth less than $491,000.
Yes.
Okay, so that
and the property on your own, Amanda, that must also be
less than 490,000. Now, so let's just say you're right at the caps in each of them. So you've got $480,000 worth of property land value that you own together across your two houses, and then another house that you own that's say worth $480,000 land value. In which case, 50% of the value of the properties that you own together is going to be given to you, Amanda, and 50% to your partner. Okay, and so then that'll be 480 divided by 2, so that's 240. She's got, she's
you've just confirmed that you've got two as a rental and one that you live in. So I think it's important to clarify that the one that you live in will be land tax exempt.
Land tax exempt,
So you do not pay land tax on the property that you live in, your principal place of residence. So that is excluded. So the only properties that we're referring to in relation to land tax are properties that are rental properties.
Yeah, and so the real question here is, like, does when you take the 50% of the property that you own together
jointly,
and add it to the property that you have in your own name, is that more than the 450 threshold?
Yeah.
So
basically, if the answer to that question is yes, then you will start paying land tax.
Oh,
so
and sorry, I said 490 before. 391.
450 is the threshold.
We're going to go through all the rates before. I've got too many numbers flashing around in my head at the moment.
So I guess, Amanda, just to summarise, if the 50% of the property that you own jointly with your partner, added together with the property that you own on your own, if that exceeds $450,000 in land value, then you will start having to pay land tax. But it will only be a minor amount of land tax at that level.
Correct, yeah.
It's not going to be a huge amount. So hopefully when we go through the example that I'm going to run through in a minute with Adrian, that will also help to give some clarity around your situation, because it's similar to your situation in some elements.
And the other thing is when Amanda's got numbers like on this, would she be able to send them through to you and then you?
Yeah, absolutely. We'd be happy to help you out with the numbers. So if you want to send them through privately, we can do that as well. We've had a few more people join in. So hi Sean, hi Amanda, hi Marissa, hi Lucio, Emily, Serena. Thanks for joining us, guys. Really appreciate you tuning in. Feel free to leave a comment below. We'd love to hear your questions and your comments. We had another question come through from Adam through the week. Adam asked about his parents. So they actually have two properties, his parents. One in town that they live in, and they also have another property in Mannum. So they spend time living at both properties currently. They have the one in Adelaide that's actually listed as their principal place of residence, so that obviously has the land tax exemption. The one that they live in, or the other property they have in Mannum, is basically another property that they live in. So he wants to know what's going to happen in their situation, given that they own two properties jointly, one that's exempt from land tax but one that's not exempt from land tax, and went as far to say that, obviously in this situation, whilst they're married, can they possibly claim both as principal place of residence to get the exemption? Is that a possibility, given that they do effectively live at both, half the week here and half the week there? So
there's two parts to this question. The first is that which is your principal place of residence, and can you claim a principal place of residence for two people? And the second part is if there is one of these that is not a principal place of residence, will that be subject to land tax? So let's go backwards. And so like now what's changing in relation to this scenario is the rates of land tax that will apply on the property. So given that the threshold is going up, it's probably like, I don't know what the value of the Manor property is or your other property is, but you might end up paying like less and being under that threshold. Now,
so that's a really good point. I'll just stop you there because I just want to say that again because I think that's really important, is that in this situation, nothing is being aggregated.
Correct.
So the land tax situation actually isn't changing from a policy perspective. But what's actually happening is that the land tax rates are reducing. So in this situation, if they are currently paying land tax on the Manor property, for example, then they can expect to pay less land tax on the Manor property moving forward on the basis that the land tax rates are coming down and the thresholds are going up.
Yep.
So I think that's the first point for Adam's parents, is that if they are paying land tax currently, they can expect that to reduce. If they're not paying land tax currently, they can expect that to continue.
Yeah.
Would that be fair?
That's a pretty reasonable assumption.
So let's say that they are paying land tax and they don't want to pay land tax. What other options are available to them? I mean, it might be controversial options. Let's
not separate like now. The question.
I mean, if they were separating.
Well,
what would the situation
well,
be?
then if they're separated...
If they were going through a separation, would that change the situation?
Yeah, well, then you just say one person lives in one house and one person lives in another house.
So what's the risk involved in trying to get away with something like that?
Well, so this is not a legal... Well, in some ways it's a legal question, but it's not based on how the law works. It's based on how the facts are. So let me give you the really simple summary. Now, if the facts match what you're claiming, then you should be okay. So if factually you are living in two houses, then separately, then you should be not together. Yeah. Now
so if husband's getting all of their mail directed to one house, wife's getting all of their mail and bills directed to a different house, and they're effectively operating two households individually.
Yep, you can claim it now, and
I've two principal place of residence exemptions.
Yep. Now, Revenue SA I can tell you, first time that they see a husband and wife who are living together and they're not separated and they're living two properties, they will question it for sure. Now,
so there is a risk there.
They'll question it, but then that comes back to, are you factually doing it? So if you, now.
And what would they do? Would they conduct an audit? Or?
Yeah, they can do an audit. Now, I've had principal place of residence audits for clients, and it's gone down to where your mail is, and and they'll check where your electricity is. They'll get your phone records and see how often you're there, and are you, is your phone showing that it's making phone calls from there? How much water are you using? Let's have a look at the property. Show that kind of evidence. Is there a bed there? I've had all sorts of.
So do they actually come and visit the house?
I've seen some visits of the house or taking photos. I haven't actually seen.
Okay.
I've seen on the other hand, I've had some people try some cheeky things. Who they've put a mattress on the floor and said, "Oh, I'm living here," and then meanwhile they've got a really nice house. Just up the road.
Well, we are probably getting a bit distracted.
Yeah.
But I think the bottom line is that we're hoping that no couples feel the need to separate or divorce.
You don't need to divorce. No. I mean, if you do want to divorce, do that because that's what you want to do.
Land tax should not be.
Honest to God, I had a client come to me and we were talking about tax structuring, land tax structuring. And he said, "Oh, if I need to get rid of my girlfriend of 15 years to save money on tax, I will." And I damn near fell off my chair. I was like, "Well, no, look,
land tax should not be the consideration to make that decision."
Yeah. And I was like, "Yeah, please, let's don't divorce your spouse over tax."
So hopefully we've, I guess, gone through some myths there. That firstly, principal place of residence is exempt. Mm-hmm. Secondly, if you only own one property individually, then your land tax rates are likely to go down, or if you're not currently paying land tax, it's likely to stay that way. Probably where these provisions play a role is where you've got properties owned in multiple different ownership structures. So we're going to move on to the joint in a minute, but before we do that, I do want to run through Actually, no, we will talk a little bit about the joint situation of where you own property jointly with another person, still individual names. Before we do that, I'll shout out to Penny, Dino, Richard and Delia. Thanks for joining in, guys. Really appreciate you being live with us today. So please send through your questions and comments as we go. So joint ownership. So we've talked about individual, let's talk about joint. So joint ownership is basically where you've got husband and wife or two friends or two family members that own a property jointly. Okay, so Adrian's already touched on the fact that where you've got that situation, you talked about the white acres.
White acre, black acre. Yeah, so this is actually white acre and black acre and green acre have been used for hundreds of years in legal examples about properties. Based on like the different colours of fields, and so you have black acre and white acre.
Yeah. So basically where you've got husband and wife, husband owns one's property, wife owns one property, they own one property jointly, means 50% of the property they own jointly will go to husband, 50% will go to wife, and that 50% effectively will be aggregated with their individual holdings to produce their new land tax rates. Now this is actually where some people's land tax is going to increase substantially. So I actually want to go through a scenario. Can we do that? We're going to grab the whiteboard out. This is a bit of a new experience for us at our Facebook Lives. We haven't normally done the whiteboarding, so bear with us while we get ourselves set up. Just put that straight. Okay, so what we're going to do is we're going to look at this situation. I'm going to move out the way a little bit so that you can see what's going on. So in this situation, this was a client, this is actually one of our clients, and they have a principal place of residence at Keswick that they own jointly with a land value of $550. They've got an investment property in Everett Park that they own jointly with a land value of $630. They've got another investment property in Keswick that the husband owns in his own name at $495. They've got a commercial property at Richmond that the wife owns with a land value of $700. They've got a property in Ashford that the husband owns jointly with the husband's parents for $300. And then they've got a property at Keswick that's owned in a self-managed super fund at $380. So what we're going to do is we're going to go through and talk about how these properties will be treated from a land tax perspective. Now I've done some calculations, Adrian, and I want you to tell me as we go if I'm getting it right.
Well, let's see how great my maths is.
So, firstly, principal place of residence, land tax payable is of course $0, because that is exempt from land tax being the principal place of residence. Now this full scenario and the calculations are uploaded to the comments in the Facebook post, so you'll be able to refer back to it and see it as we go through. We're going to just clear out the ones that are easy and then we'll go to the ones that are harder. So I'm going to jump to the bottom. This property at Keswick in the self-managed super fund is also excluded for two reasons. Because self-managed super funds are excluded from aggregation.
They're excluded from aggregation, so it's not going to be added with anything else.
But it's subject to its own land tax.
Well, yes. So that means that it's facing its own threshold, and because 380,000 is less than 450, then we're out.
Right. So no land tax here. No land tax here.
But of course, if this was 880, there would be land tax.
There would be, but it would be at the individual tax rate.
Correct.
So where you look at the tax rates that we've uploaded, there's two tables for each year. One table is the general rates, which is where the SMSF would apply, and individual holdings. The other table is the trust surcharge. So for this example, you can ignore the trust surcharge rates because there's no trust included in this example. So that leaves us with the rest of the properties. I mean, clearly this one here is going to be allocated 100% to the husband, and there's nothing you can do about that. This one here is going to be 100% to the wife. Okay. This one here that's owned jointly, remember how we said that 50% will go to the husband, 50% will go to the wife. So half of 630 is what, 315. So that will be plus 315 plus 315. Now, in this situation here, where the husband owns with the husband's parents, we assume that each person owns 33% each.
Sure.
That adds up, right? So 33% will go to the husband. I got that right?
Yep.
We've got 50% going to the husband and 50% going to the wife. Makes sense so far? So I'm not going to go through each of the individual calculations, but so far we've got pretty much the structure right, Adrian?
Yep, agreed.
Yeah, so basically what it ends up being is that it ends up being that the land tax payable for the husband works out to be $3,450. That's not a very good 5. And that's in 2021, and the land tax for the wife ends up being $4,325. Okay, this is based on the husband having an aggregated land holding of $909,000 just for the land value. The wife has an aggregated land holding of $1,015,000 for the wife. So this is how the numbers work out between them.
So this is probably going to be a little bit more than they're paying at the moment.
Well, it is a lot more because currently they're paying just under $2,000 a year.
Yeah, because I was going to say we're going to go. So that would be exempt under present.
Yes.
And then we're going to say this is going to be taxpayer 1, husband and wife, taxpayer 2, husband, taxpayer 3, wife, taxpayer 4, husband and husband's parents, and then taxpayer 5. So there's no real change for the SMSF. And so...
so they're going to have quite an increase in their land tax bill, going from just under $2,000 a year to a combined tax of $8,200 a year. So, however, it could have been a lot worse.
Yeah.
Now, by 2023, based on the rate cuts that are coming, their land tax bill combined will be down to $6,500. So that's...
It's a bit more manageable.
It's a bit more manageable. It's not as bad as it was. And the clients in this situation will be potentially eligible for the relief package that we'll talk about at the end of the Facebook Live. So tune in for that as well. So the full calculations for that scenario are attached as well. Is there anything else you want to add to that scenario, Adrian?
We just want to think through that if... like what property is owned by the wife. Like I'm looking at the value of the property here, and so you think you can shift property for about 5%, 3 to 5% stamp duty, and so one of the things to consider is what's the rate that you're paying, and are you paying what will be the returns to do that?
Well, that's an interesting question, because if you did change the ownership of the residential properties, you would have to pay stamp duty and capital gains tax potentially. But there's no stamp duty on commercial properties. So in this situation, they have a commercial property at Richmond. Like if they actually wanted to sell that to a new company entity.
By transfer.
Transfer it to another entity. Would that potentially help them, or would that ultimately?
Well, that would probably So what I would suggest in this case is, so if you transfer the Richmond property, which is a commercial property,
which is the most expensive one as well, so that's actually making that land tax quite.
So if you transferred it to a company, the shares in the company, it'll look through who owns the shares. And so ultimately, it's will it be the husband or the wife who owns the shares? So that's not going to work. But if you transferred it through to a discretionary trust, now you're not going to be able to nominate, so it's going to be taxed at the trust surcharge rate. But it's probably, just off the top of my head,
it'll probably be cheaper.
Yeah,
I think it will be.
It'll be. I'm pretty sure it'll be.
So that could potentially. So one potential option is to transfer that to a discretionary trust and actually pay the trust surcharge rates for this, and then that would mean that instead of the wife getting taxed at over $1 million worth of land, she'd get taxed
on
at
a
just
315, which is going to be nothing.
Well, it won't be nothing because the way... This is one of the sneaky things that Revenue SA...
Here we go. Sorry, yeah.
I'm going to point this out.
Go.
This is so sneaky.
Yeah, go.
I feel this is really sneaky. But what they're actually doing is that... I'm just going to read this part out, right? And then I'll explain it. Joint ownerships will receive land tax assessment bill as at present. But if the joint owners also own other properties in their own right, they will receive a separate assessment for their total land holding. So what that means is... This Everard Park property that's owned by husband and wife, this husband and wife will continue to receive a separate land tax bill just for that property, based on just what that property would pay land tax, or what the land tax bill would be on that. Then each individual, so the husband and wife will also individually receive a land tax bill with their own individual land tax on an aggregated basis.
Can I draw this? So you've got...
Yes.
You're going to have the joint taxed at this level.
Yes.
And then it flows through...
Maybe get a different tax.
Oh, sorry, working... Yeah.
Because it might be...
Yep. Thank you. So we're going to have joint, and you get taxed at here, and then that tax flows through down to the husband and to the wife. Am I in the way? Oh, no, cool. Now what happens is you pay tax at there, but then it flows through and they get a credit.
Yeah, so I actually worked out what that was. On the table you can see it. So the credit is, because this Everard Park property, in 2021 the land tax payable is $900. So effectively what happens is that they will get a bill for $900 jointly.
Yeah.
And then what happens to the husbands is that they'll get a bill for $3,450, take $450.
Yeah.
Which is half of the $900.
Yep.
And that will be take $450.
Yep.
Which ultimately...
it leads to the same amount.
It leads to the same amount, but this is where it gets sneaky, is that if the wife was only owning 315, then theoretically she wouldn't have to pay any land tax because it's below the threshold, but she still has to pay that 450.
Yep.
That's where it's sneaky.
Yeah, it's pretty bad.
Do you agree?
Absolutely.
Sneaky.
It's just
so sneaky.
So it's like, let me give you another example. So in the last federal election, people were really angry about franking credits when Labor said we're going to get rid of franking credits. Now the reason why
one of the big reasons why I don't think they got voted in last year.
Correct. And so, because what happens is you get taxed at the company level, say between 25 and 30%, and then that you get a tax credit that flows through to the shareholders. Because what used to happen is you'd pay 30% tax, or it used to be 40-50% tax at the company level, and then the income, the dividends would come down, and the individuals would be taxed on it themselves. So you get double taxation. So that's why franking credits were introduced, and they're a really good thing. They're a really good mechanism. And what happens is that you can, if say you're getting taxed at 30% of the corporate rate, and then the person is a super fund, it's at 15% rate, or a retired person who's getting taxed at a lower rate, or they don't have much other income, that they get a franking refund. Okay, and so that way, the idea is that you're going to look through to the ultimate owner, and they're going to get taxed at their income rates. That's how franking credits are supposed to work, and they do. And luckily, Labor didn't change them.
And then you get the refund.
You get a refund, yeah, and so that you're paying tax at your marginal tax rate. Now here, though,
so
you've basically got franking credits, and it works for joint owners or for companies.
That's a really good way of putting it. I haven't thought about it that way, but it's true. That's exactly what's happening. It's
like franking credits, but you can't get the franking credit refunds. It's really sneaky.
That is sneaky.
Well, I got a suggestion.
Another suggestion.
Another suggestion. Besides moving this out, now the problem that you're going to have here with the husband and the wife is that they own 50% each, because they're going to be joint tenants. And so that's a joint ownership. It's a separate ownership. What you could do is you could sever that joint tenancy.
And make it tenants in common.
Yeah, so that wouldn't incur stamp duty because they start off each owning 50% as joint tenants. So that what happens is a joint tenant is you're both on the title and you each have an undivided amounts, and it's and so you'd have a 50% interest in everything. Now, a tenancy in common is you're going to sever it, and so you have 50% of just your part.
So that could actually work well if they ended up putting this property here into a trust, and the wife's ownership goes down to 315, and then they ended up changing that to tenants in common, where the wife owns 90% and the husband owns 10%, or something. You know, whatever the calculations are, then ultimately that might reduce their group land tax substantially.
Correct.
So
it depends on the property, depends on their ownerships. We're making that's why I said we're making some assumptions.
So
here.
the good thing is that there are options and solutions.
Yeah,
so you're not trapped into this. So I think definitely that's some really good thinking of ways that you can work through it. And so would those changes have to be made before 30 June? They would have to be made before 30 June. So you don't have long to make them. So I guess the key is that if you are in a situation where your land tax bill is going to increase substantially and you do want to make some changes, then it probably is really important to sit down with someone like Adrian or an accountant or a lawyer to actually nut it out and go through the different scenarios and consider potentially changing some ownerships of some of the properties, or changing the percentage of ownerships so that you can actually make it work for you.
Well, the other thing that you really need to think through is, so we're just looking at this from a tax perspective. So now ultimately though, we're changing people's rights here. You know, so if we're moving this property out of the wife's name into a trust, we're severing a tenancy in common, whatever kind of restructuring we're doing, we're going to need to think through like asset protection. You're going to need to think through where your income tax, where the income from everything is going to flow or has the ability to flow. You think of what tax rate you're going to pay it at. You're going to think of, are you going to trigger capital gains tax? You're going to think of your succession planning. You've got to think through, are you going to transfer something to someone who's going to get a divorce?
That is such a good point, because I think it's really easy to get caught up in this land tax discussion and make changes just to reduce your land tax, but that's really only one very small piece of the puzzle. And all of those other things that you just talked about, like the asset protection and the income distributions, they're just as important to consider when making these decisions. And that's why it's really important to get some professional advice that's specific to your situation, so that you can actually work out what is the best overall situation for you moving forward. So, great point, Adrian. In the interest of time, I'm going to move us on. We're probably going to run overtime today, but I just think this content is so good that hopefully you can stay with us and continue this discussion. Shout out to Michael, James and Andrew. Thanks for tuning in, guys. Please feel free to leave your questions and comments below. So, I'm just looking... I wanted to ask another question before with joint ownership. How does it work if it's joint ownership with a trust or a company? So in this situation, we've talked about joint ownership with two individuals, but what if the husband owned something jointly with a trust? It would be treated in a similar way?
Correct,
where, the percentage of the
So
trust
it's going to create a separate owner and it's going to flow through to him, but ultimately we're still going to have that two levels, and you're sort of essentially franking credits or land tax credits.
So I think we've covered individuals. I think we've covered joint owners. So we're going to move on to companies.
Sure.
And I don't know if there's a lot of people in our audience that own property purely in companies. So we're just going to touch on this quickly and then spend more time on trust, because I think that's the big one. But I'd like you to explain...
Companies is the bad news story.
Companies is the bad news story. But now just to clarify for me, when we say companies, is that for properties that are held just by the company? That doesn't apply to
a company that owns it as a company trustee. Yes, that's right.
So a trust with a corporate trustee, that's considered in the trust category?
Correct.
So this is just property that's owned just in company with no trust attached.
So where this really hits, the reason you'd own property in a company is probably because you're a developer, and so you're going to be making revenue out of it rather than holding property for the purposes of it increasing in value and you getting rent out of it from time to time. If you're holding property like trading stock, like a greengrocer might buy apples, that's their trading stock. Then you have it in a company because you're going to pay a lower rate of income tax. Now, if you're holding it as capital, like a tree that grows the apples, and the apples being the rent, then then you're probably going to want to hold it in a trust, because trusts will flow through the capital gains tax discount down to individual, and so you'll end up paying a much lower rate of tax generally than you would a company. Although actually with the corporate tax rate, things are going down. It's the maths is a little bit subtler. But rule of thumb, if you're going to hold something for a longer term, you're going to hold it in a trust. The reason you're going to hold something in a trust is not only to be able to split your income, but also for asset protection. Like if you go bankrupt, you don't want to lose the assets that are in the company, the assets that you've built up in the trust. And for capital gains tax reasons, and also just from an accounting perspective, you want to have things management accounting done like that, done separately. So that's why you own property in a trust. If you're a developer, you're going to own property in a company. Some people own property in a company because they was a bad decision in the past, and you've inherited it that way. And
so you said that companies is the bad news story. So let's just explain that a bit further.
So it used to be the case that if you owned Whiteacre and Company 1 and Blackacre and Company 2 and Greenacre and Company 3, they would be disaggregated. They'll be treated as separate taxpayers. Now, what happens is it looks through to the are these related companies? So do they have directors in common or shareholders in common? And
so
it's
basically looking to see who is the main controller as an individual. Bring it back to an individual.
Well, it creates a corporate group, and then it says, let's put all of these together. Yeah. So it doesn't. You don't even have the fun of saying half of this to the wife and half of this to the husband. You're going to go, this is one big corporate group, and we're going to aggregate them all together. And
will that be aggregated with? So if they do like a big corporate group, will that also be aggregated with the individual's holdings?
No. Potentially depends on what their ownership is.
Okay.
So
potentially, if they linked that group back to a husband and wife, could that be aggregated with the husband and wife
potentially?
Joint ownership?
Yeah, it's potential.
Whereas if the group is beyond the husband and wife, then perhaps it would be
it's going to be really difficult to disentangle them.
Yeah.
Because they're going to be directors or shareholders.
So would a solution to that be adding new directors?
Well, the thing is it's going to trace through who they are, and it's going to say, are you related? It's actually, unless you had a whole bunch of random people that you found to be directors, and people do that though. I mean,
there are professional company directors.
Yeah,
I guess.
You can get professional company directors, which are expensive, and then there's unprofessional company directors, which are.
I think with that one we might just leave it there.
Yeah.
I don't think it's going to be like a big issue for a lot of our viewers. But what I would say is that if you do have properties that are owned in a company alone, you should definitely get advice about that, because there might be something that you can do between now and 30 June to help with the situation. Because as Adrian said, that is the bad news story of these changes.
This is
so
the loose.
So you want to make sure that you don't put your head in the sand and we had a question that's just come through from Andrew. How likely is it the government will have the smarts to get the aggregation right?
I think here's what they did poorly.
How much confidence do we have in them, Adrian?
No, I don't think they're going to change it. So what they did poorly, just from a purely political perspective, is they announced these changes as they said that we're just trying to tighten up on a loophole. Now this isn't a loophole. This is totally doing a new change in tax. Now it's okay for governments to change tax systems. They do that all the time. That's what their job is. What you should do though is if you're changing the tax system, you should announce that we're going to do a big change. We're going to increase tax for some people and get people on board with it. You know what? Because people, you have a responsibility to make sure we pay for our hospitals and schools and roads and police and firemen and all these other things, and we don't mind doing that. For people
they just didn't handle the process very well.
They didn't handle the process well, and then what they did is they stuck to
to really know what they were doing.
They stuck to their guns, and they're like, we're just gonna dig down. We're just gonna keep digging. We dug a hole. We're gonna dig a deeper hole. And so here's what they ended up with a tax that raises negative money over the next 3 years. They've caused a whole bunch of pain to people who are honestly like aspirational voters generally.
Yeah.
They're like core liberal constituency. So they like totally screwed themselves. The Liberal Party donations are going to go crash. The thing is people who voted Labor, they were going to vote Labor anyway. Like this stuff, they don't really care about this. Labor opposed it, but ultimately, when Labor in 3 years' time, the money's going to be there for Labor, so they're kind of the winner out of this. So they totally screwed it, and they've dug themselves so deep that they can't change it.
So it's clear that the government's not going to reverse the changes that they've brought in. But I think Andrew's question, I'm not sure if that's what Andrew was asking, or whether he's asking whether the aggregation part of it will be correct in terms of them identifying husband and wife, and identifying trusts and identifying companies and actually aggregating that to the right person. I wonder whether Andrew's question is more along those lines. No. Do you think that's something that they're going to get right?
We'll see minor tweaks going forwards, and every 3-5 years we see some tweaks. They're not going to make things nicer for people. They might just try and patch up some problems.
I guess it comes down to what you said right at the beginning of this segment, where whilst we can read and understand the legislation now, we just don't know how Revenue SA is going to apply.
Yeah.
And that's really Revenue SA's job, to do the aggregation part, isn't it? To actually, work that out. Andrew's actually just clarified his question.
Yep.
He's talking about the
staffing levels,
the need for more forensic accountants to find linked relationships.
Oh,
you're talking about the staffing levels of Revenue SA. So that's probably with companies, like we said, that's probably really hard for Revenue SA.
Do you know what? I've seen
there's so much work involved in having to, the forensic accounting, like Andrew's suggesting, for them to actually work out.
I've seen Revenue SA trace companies across jurisdictions, and
so you're pretty confident in their ability to do that
over a longer term.
Yeah, so they might not get it right initially.
Well, no, it's more a case of
long term.
Okay, it's more a case of you got to think of the tax office. Tax offices generally as a big, slow-moving machine, and there will be all sorts of things that you can easily dodge out of the way of, like a slow-moving tractor, right? But it's just coming there. It's like the Terminator. That's it. It doesn't feel pity or fear. It's remorseless. It will not stop.
So you're basically saying that you're very confident in Revenue SA ultimately working out the actual ownership of a company.
It can't. So the tax office.
Not work it out straight away.
So to paraphrase, the tax office doesn't feel pity or fear. It can't be reasoned with. It can't be bargained with, and absolutely will not stop until it gets you. So.
And it's clear to say that Revenue SA has many avenues to access information.
Sure.
So they can access a lot of different information from the tax office and from different sources to navigate their way through understanding who are the rightful beneficiaries, the rightful owners. Would that be fair to say?
Correct. And so you might have an ownership that's of a company or something that they miss, but that's why they have auditors and they have all sorts of information that gets fed into systems that says, oh, here's something to review, and therefore they audit things. There is absolutely things that fall through the cracks. And on the other hand, I've seen them, years later go, here's these problems, here's something we've missed, we've found it, and we'll come back and chase you.
In that situation, right, if they do find it, say, 4 years later, can they actually like pay, like can they actually charge you for
Yeah.
the previous years?
Yeah.
Like could they say that if they haven't sort of connected the dots initially and then they connect the dots like 4 years later, could they say, well, now for the last 4 years you owe us all of this extra land tax?
Yeah,
because you should have been paying
there's
that all
actually
along?
two pieces to that. One, yes, they can, and two, there's a whole bunch of different nominations and notifications that you now must make to Revenue SA. So it used to be the case that you don't have to make any nomination, and if Revenue SA finds it, then they'll assess it that way. For example, if you held property, so if a company held property in a trust and you didn't tell them about the trust, it would just be
it with any other property that company owns.
Yeah.
Because they would look at Revenue SA have already been doing forensic accounting on this sort of stuff for years, trying to work out which trusts and companies are grouped and having a look at what the ownership on the the titles are. I mean, I know that we've had a lot of clients who have been caught out by Revenue SA forensic accounting work.
Yeah.
So I mean, I think that in answer to Andrew's question, I don't think you can really hide from this, and you're probably better off taking the front foot and working out exactly what your position is, and rather than trying to hide it and eventually getting caught, it's probably better to actually be realistic about where it's going to sit with Revenue SA and actually proactively plan for it, with some of the suggestions that we've raised today.
And more specifically, you actually must make notifications. So when you buy property in a trust, you have to notify. You have to notify if you change the beneficiaries of the trust. If you have units in a unit trust and you have to sell.
So missing out on those notifications, what are some of the ramifications?
There are penalties that you'll get if you don't make the notifications, and you've got, I think, was it a month to do it?
So those notifications mainly relate to if you've got a trust or a company ownership structure?
Yes, yeah.
So it's important, if you don't understand that, or if your accountant's not on top of that, that you actually get some proactive advice around that. And don't just assume that your accountant's doing it. I would ask them and really just understand that is happening.
So if anyone does want to have some fun though with these notifications, because there's a lot of notifications, what we might do is we buy like a really small piece of property somewhere, put it in a trust, and have like thousands of people own it, and we trade little pieces of it every day. There's going to be no stamp duty on trading it, but there has to be, and then I can easily set up a computer system that will generate a notification every time there needs to be one, and we'll just flood Revenue SA with that.
I feel like now we're getting a bit carried away.
It's a little bit vindictive. No. I wouldn't actually do that. No.
So we did get a question through from Ray. Is there going to be land tax due if the value is below the threshold?
Well, no.
No land tax due. And there is a second question. The property, and the property is in the family trust with the owner and son as beneficiaries. So Ray, we're going to move on to trusts, and then we're going to answer your question.
Sure.
Because I feel like maybe she owns a property in a trust where the value is below the threshold, which is below the 450 threshold. But let's talk about trusts in general, and then we'll come back to Ray's questions. I feel like we need some context around trust before we go into that.
Yep.
Tell us, what's happening with trusts?
Well, so there's two different types of trusts.
Yes.
So now we've got fixed and unit trusts, which are kind of like companies where the trust will own something, and there will be people, and then the unit holders or beneficiaries will have a fixed interest in that. So they might have a unit trust that holds property, that holds Blackacre, and the husband owns 50% and the wife owns 50%. And in that case, it's kind of similar to the joint ownership we were talking about before. What it's going to do is it's going to follow through who owns the property in the unit trust and what's their percentages,
and that will just get
flow
added
through
to
them.
the individual.
Yes.
Yeah. So what about in the case of discretionary trust, which I think is a very popular ownership structure? So a lot of our viewers will have that structure.
Yeah. Well, so if you have a discretionary trust,
which I assume is the trust that Ray has.
Yeah.
A family or discretionary trust.
Yeah. So a discretionary trust doesn't have a beneficiary. It has a class of beneficiaries, a bunch of people who it could potentially benefit. And so there isn't actually one person that is the beneficiary. Now. So what will happen is if there is for trusts that owned property before 18th of October 2019, when the legislation was introduced, they can make a nomination until 30th of June 2021 as to who is the beneficiary for all of the land held in the trust. One nomination. Now, this, and then that person that you nominate will be treated as if they are the owner of all of that property for land tax purposes.
Okay, so just to backstep, just to paraphrase what you've just said. So if you own land in a discretionary trust, you have two choices. One choice is that you can nominate an individual beneficiary to effectively pay land tax on that based on their individual rate, which would be based on the general land tax rate.
Yeah, well, it happens with it gets the franking credits system come through.
The general land tax. Yep. Or you can choose not to nominate a beneficiary and you can pay the trust surcharge rate. So when you see those tax rate tables that we've uploaded, you'll see that there's a different rates and thresholds for trusts, which is called the trust surcharge rate. Is that correct?
Yep. So it's 0.5% higher for trusts. And the threshold's
25,000 instead of 450. So in Ray's situation, if she's owning a property in a trust currently, the land must be less than 391 for her not to be paying land tax at the moment. But if the land exceeds 25,000, which I assume that it does, if she doesn't nominate a beneficiary for that trust, then that trust will start paying land tax on that land.
Yep.
Otherwise, she has the option of nominating a beneficiary, which might be her son or some other beneficiary, and then that means that the land holdings in that trust would be aggregated with the beneficiary's individual ownings.
Correct.
Now, let's say that Ray decides to do that. Let's say that Ray decides to nominate her son as the beneficiary for land tax purposes. And let's say in the future that her son gets married and divorced. What happens to that asset?
Well,
because at the moment the asset is protected from her son's relationship.
Yes and no.
Potentially.
So let's look at asset protection. There's two main prongs to asset protection. One is against bankruptcy or being sued. Two is against divorce.
So is a trust an effective asset protection against bankruptcy and being sued?
Yes, definitely.
Is a trust potential asset protection against a relationship breakdown?
Not since the 80s.
Okay, well let's say that the mum and dad, let's say that Ray's the trustee. We obviously don't know the details here, but let's say that Ray's the trustee of the trust and controls the trust, and her son and maybe other children are beneficiaries. So if her children are beneficiaries and they go through a relationship breakdown and it's a discretionary family trust, but they don't actually have control because they're not the trustee, would the assets of that trust be exposed?
So let's make some assumptions there. Let's say we've got a mother who's put if the mother has paid for the property herself. Or got it through her own means, set up the trust, and she's the controller of it, and then she has some children, 3 children, and one of them gets divorced. That property would be unlikely to be taken into account for the child who's getting divorced.
Okay. What about if she only has one child and her and the child are beneficiaries of the trust?
That should be fine as well, unless she's just about to pass away or she passes away, in which case it'll go into the estate.
But that would assume that she would have to pass away before the relationship breakdown?
Yeah, or before the divorce is finalised.
Okay.
So one thing that traps people is that they'll get they'll separate and then they haven't finalised their property settlement, and then a couple of years later someone gets an inheritance and then suddenly that inheritance becomes part of the matrimonial assets.
Okay.
Yeah.
So let's now get back on track and say that with these new land tax provisions, if Ray does determine to nominate someone, let's say her son, as the nominated beneficiary, what happens? What are the risks of doing that, I guess?
Well, so it's not. If the son goes bankrupt, he's not getting an interest in the trust, so it's not going to damage your standard asset protection, and it doesn't give the son any additional right to call upon the property. So if the parent
they have a fight falling out in the future, her son can't sue her for the property.
Correct.
Right.
Yeah.
Okay. But what about if the son goes through a future relationship
divorce? Well, so what's going to happen now? So the family court doesn't really follow law. Like it just sort of makes things up as it feels like.
Right.
And so what?
That's useful. Isn't
Yeah.
it?
So the way of dealing with the family court is to make things like feel like that they're not owned by someone. Now you can do that. Now the question here is that this is going to be another thing towards making it feel like it's the son's property. So now if the son is just a nominee for land tax, he doesn't get income from it, doesn't control it, doesn't have anything to do with it, it's probably going to be okay. Probably.
But we can't be sure.
No, it's the family court. It can do whatever it wants.
It is a bit of a risk, I guess, that it could be exposed to relationship breakdown of the beneficiary if you choose.
So this is why I said when you're making nominations and thinking through this, you need to think through not just your tax, you need to think through your asset protection, think through what your succession planning, think through whether your child is with a terrible spouse.
Yeah. And once you've actually nominated a beneficiary, can you change that nomination down the track?
Only if the beneficiary dies, becomes incapacitated, or you're changing it as part of the beneficiary's divorce.
So you got to think seriously long term about nominating a beneficiary, because this is like a once-off opportunity.
It's one
chance.
off. Yep.
They need to agree to it because they need to sign it. The beneficiary needs to sign a stat dec.
Yep.
So they will be aware that they are the nominated beneficiary.
So we can't just all nominate the Premier. It's funny as that.
Wouldn't that be great?
It's actually, people used to do that. In the past, they would distribute money out of their trusts to the Prime Minister or the tax commissioner, and then and so not actually pay it, but then the commissioner would have to pay personally to the tax. So that was stopped a long time ago. But here, you can't make. The treasurer.
I've had a lot of questions about whether people should nominate like an overseas or interstate relative.
Yeah, sure.
As their beneficiary, and I guess the answer is probably that they can.
Yeah, you can. Yeah.
But they would need to be made aware that they are the nominated beneficiary. They need to sign a statutory declaration.
Like you can't just say, "Oh, look, there's like billions of people overseas, and let's find a new beneficiary."
Yeah. So, and I guess the risks, and I was reading an article on the risks of choosing a foreign resident is that the government could later apply some foreign tax rules around that.
So there is a foreign resident surcharge tax for purchasing property in South Australia. So if you have a property that is where a beneficiary is a foreigner, then you're going to pay a surcharge rate of stamp duty.
So if you all of a sudden nominate a foreigner for
land tax, so there
would that potentially
so there is a bunch of jurisdictions where there is a surcharge rate of land tax for trusts that hold where one of the beneficiaries is a foreigner. So for example, New South Wales. In New South Wales, you need to make sure that your trust cannot distribute to someone who is overseas. Similarly in South Australia.
Okay, so it's not that easy. So you need to get your trust deed reviewed.
Well, before
you actually can nominate someone for land tax.
Yeah, so you shouldn't be. I wouldn't. It would not be a wise decision to start to nominate a bunch of overseas people. You might.
That aren't really connected to the trust.
Well, even if they're not, even nominating overseas, you might get a bit of a benefit for a couple of years, but I would put money on there being a surcharge rate of land tax.
In the future.
Yep.
So we did have a client, Trevor, who actually asked about the implications of nominating an interstate relative who have no plans of purchasing any property in SA in the future. So what are some of the implications? Let's say he wants to nominate a sister. For example, what are some of the implications of him choosing to nominate a sister who lives interstate with no plans of purchasing
so that
SA?
works all right. The thing is I don't know exactly how this gets administered. So you have to make a nomination. I don't know what the nomination form looks like because Revenue SA haven't drawn it yet. Or haven't published it yet. So it might be the case.
If she has a relationship breakdown, there is a question as to whether the asset could get exposed.
Yeah, I think the family court breakdown is the big one. Going bankrupt is not so much a problem, but when someone's a relative and you've suddenly given to them, you've declared to the government that this person is the beneficiary of all of these assets.
Do you think, I know you're not a family lawyer, but I'm just thinking as we go, do you think there'd be a possibility for that person to potentially, before they get nominated as a beneficiary, do some sort of prenup or some sort of agreement with their partner saying, I'm going to be nominated as a beneficiary for land tax purposes for this parcel or for this trust, but I have no control over. It's not, it's not part of our.
So is
that something
yes,
that could be possible?
Yes. Now I have written papers on trust busting in the family court. So so I do a lot of trust stuff, and seeing how the family court takes its own little spin on it is something that I'm familiar with. And so one of the things you got to be careful about is that if you're saying I'm just doing this for tax purposes, you're potentially making it really easy to get caught under anti-tax avoidance rules.
So if you're not nominating someone just for land tax purposes, then that probably gives the family court more leverage to say that person actually is entitled to that property, which means that the family court is likely to drag that into the mix in a divorce settlement.
Yeah, more likely to. They might not. Like, I'm not saying that they would. I'm just saying that you're now making.
It's a big risk.
Divorces are terrible. Like, 50% of people get divorced.
Yeah, and it's a big risk because we haven't seen it play out. I mean, I don't know if you know, because obviously they've got a similar. I think they've got a similar nomination provision in Victoria. Is that right?
Yep.
I mean, is there any evidence in Victoria? You might not know the answer, but in where this situation's played out, where someone's nominated someone else.
The family court basically, like, when it looks at trusts, it's going to look at it not according to a legalistic law perspective, but how it feels, basically.
Yeah.
So
there's no
if
way
you're
of
nominating it, it's if you're nominating someone, they're going to say, well, it looks like this. You've nominated them for land tax.
Yeah.
So they'll take it into account.
So I think in answer to that question is you can nominate anyone who is a beneficiary of the trust as the nominated beneficiary, but you need to consider what the long-term risks of nominating them might be.
And particularly, if you're doing something for a pretty clear tax avoidance perspective, like, you should be careful about that.
But given that the government's like giving us this sort of grandfathering exemption where we can nominate someone, I mean, clearly people are nominating someone for land tax for the purpose of minimising their land tax bill. Like that's pretty obvious, isn't it? So
I would say if you had 50 trusts and you nominated 50 random people overseas, I think you're going to have a problem.
Oh, right. But if it's a genuine nomination, you
sure,
shouldn't have a problem.
I think it'd be fine. Yeah.
If it's a genuine nomination. Yeah. So how and when? I think we've already touched on this, but I just clarify because one person sent the question through. How and when do you nominate a beneficiary for the purpose of land tax? So I think you said it had to be before 30th
of June, or so it's 2021. But that's your last 18 months. But you're going to have to, but you're going to want to make a nomination
much
earlier because so that
it can apply for the next
year. Yeah.
Would you say that you want to nominate before 30 June this year, preferably? So 6 months effectively to make your nomination. Yep. So get in and do it. But before you nominate, because it is like a long-term decision, make sure you've got your advice and you've done all the scenarios. That'd be fair?
Just want to say, this is such a big thing. Every advisor is going to be flat out dealing with this. In May, June. Yeah, you're
going to be busy for the next 6 months, Adrian.
We're all going to be busy. In the past, I'll go cool. It's coming up to 30th of June. I'm like, I can't. I've got a full book now of work. I can't accept any new instructions. And I've had to turn people away. Just before, when they come to me and say, "Oh, I need to do something," I'm like, "It's too late. I'm sorry."
Yeah.
So
get in early, be proactive. I think that's good advice. So I'm just having a look at my notes to make sure we've answered everyone's questions. We've spent a lot of time talking about the beneficiaries, nominating the beneficiary. Now it's important to point out that this is only available as a grandfathering provision to trusts that are already in existence.
Yeah. As
of October that has just passed. So if you already had a trust when the rules were changed, then you have the ability to nominate the beneficiary. But for trusts created after October 2019, then basically you're paying the surcharge rates.
Correct.
Is that correct?
Yeah. Now, whether you pay the
Which
surcharge...
is not necessarily a bad thing, but that's just the way it is.
Yeah, and so Ray's just questioned again whether the trust surcharge rate is applicable if property land value is below the threshold. But it is applicable. If it's below the threshold of $491,000, you're still going to be paying 0.5% on that, whereas normally you'd be paying 0.
So Ray, just have a look at the land tax tables that we uploaded to the comments, and in there you'll see the trust surcharge land tax tables. So effectively, if you choose not to nominate a beneficiary, then that land tax trust surcharge rate will be the table that will apply, and that means that you've only got a threshold of $25,000 before you start paying land tax on that. So, yes.
Can I go with the trust? Can I go through a couple of strategies that you might use?
Yes, that would be lovely. Cool. Thank you.
So, the first of all is let's take a really simple example. Let's say, and it's easier to see if we have a number of properties. So let's say someone has 10 properties. The land value is each worth $250,000.
Yes.
So if they have all of those 10 properties in one person's name at present, so in their own name or in one company or one trust, whatever, they're going to be paying about $57,000 tax a year, which is a lot. Now, if they have each one of those 10 $250,000 properties in a separate discretionary trust or company at the moment, they're going to pay no tax. So that's
with
how
the current rules.
with the current rules.
Yes, because every trust would be under the 390 threshold.
Correct. Yeah, and so that's how the disaggregation works at present. Now, under the new rates of tax, if they were all aggregated together, so they're all in one ownership, or if they're in 10 different companies that are all brought together, they're going to pay about $40,000 of land tax.
Based on the new rates.
On the new rates, and less the transitional payments for the next couple of years. But then, but if they're paying it at the trust surcharge rate, it's going to be at about $47,000. So just say they had it in 10 properties worth $250,000 in one discretionary trust. They're going to pay about $47,000 because that's about $7,000.
So that's not, just to be clear, that's not the surcharge rate. That's if they were aggregated
together. So that's the
and
ordinary.
You paid the general land tax rates and paid aggregation.
Yep. So the general rate plus the 0.5%.
Yeah.
Now.
So that's if you nominated
one
single beneficiary. All of those trusts.
One beneficiary will know that's going to be no nomination. Yeah. No. You only pay the trust surcharge if you don't make a nomination.
Yeah, but the trust surcharge rate, I thought you said was about $12,000.
About $6,000.
Oh, about $6,000.
The maximum amount is about $6,800, I think.
So in that situation where there's lots of trusts owning small property or small land holdings, it works out a lot better to pay the surcharge rate than to nominate a beneficiary.
You jumped to the end.
I'm conscious of time.
Yeah, sure. So if you had, conversely, if you had 10 properties, each of them purchased in a different trust, the amount that you're going to pay is about $12,000 of land tax.
Yeah.
Okay, so with the surcharge rate.
Yep.
And now you could even bring that down if you made nominations, like if you had a lot of individuals that you could nominate. So you could bring it down, amount to $2,000 or $3,000. So you got to pay something. But the point I wanted to make is that if you've got a lot of small properties, I want to make 2 points. First of all, is that if you've got one big block of property, so $2.5 million worth, when it's all aggregated, you're paying less. If you've got a whole bunch of little properties together and they're each disaggregated, you're going to go from say 0 up to more. Okay, so that's where everyone's been going. Oh, this is going to increase my tax. Now, on the other hand, the kind of good news is that you can, if you're going to purchase a lot of properties, just make sure that each of them is in a separate trust, and then you're just going to pay the 0.5% trust surcharge rate. Up to $490,000, and sure, you're going to pay some tax, but it's probably not like a huge amount of tax.
Well, that actually probably feeds quite nicely into the scenario example that I wanted to show you for that. So I do have a client scenario that we're going to go through. Before we do that, shout out to Philip, Katie, Rachel and Sineth. Thanks for joining us, guys. So I'm just going to do like a little flip. Just watch your head, Adrian. Okay, so this is a husband and wife example that have multiple trusts. So what we're going to do is go through this scenario just to see how it plays out, and this will show you the difference between maybe making the decision about when to pay the surcharge rate and when to nominate a beneficiary. So the wife has a land value of $550 in her name. The husband has land value of $100,000 in his name. Jointly, they have land value of $765,000. They've got a trust where the husband and wife are the trustees. So this trust number one owns $322,000 in land. Trust number one plus the wife jointly own another lot of property for $292,000 in land. Trust number two with a husband and wife trustee owns $450,000 in land. Trust number three with a corporate trustee owns $540,000 in land. And then they have as a self-managed super fund with $240,000 in land. So we know that this one here is exempt. We looked at that in the last situation because it's self-managed super fund is on the general land tax rates, and because the 240 is below the 450 threshold, there's no land tax payable. Let's look at what else we can do here. So with the joint property, we have no choice. So 50% goes to the wife and 50% goes to the husband, right? So we know that that has to be added up. So far the wife has 550, which is her individual holdings, plus half of the 765, which I don't know what that is off the top of my head. Let's see if I've got that written down. 65. Do you know what that might be? Well, we won't work that out, but this is here. I have done all the calculations. This is going to be that plus 50% of that. Mm-hmm. Plus 50% of that. Mm-hmm. Okay. So then we can decide with these trusts. We've got three, no, this one here is easy to know because 66% of this one is going to the wife.
Mm-hmm. Or 33% to the wife, 66%.
Oh, that's right, 33%, sorry.
Yep.
And then the 66% is going to trust one. Mm-hmm. So we already know how they're going to be treated. So then the choice that we've got is with this one. With trust one, trust two and trust three, we can decide whether we're going to nominate a beneficiary or whether we're going to pay the trust surcharge rates. Mm-hmm. So one of the things that I thought, Adrian, keen to hear your thoughts on this, is given that the husband doesn't have a lot of property in his name, mm-hmm. I mean, so far he's only up to about, that's probably about 370, and so he's about up to 470 approximately.
Yep.
Even with the combination of, like, with his share of the joint property. So he probably has room to have a bit more ownership. Mm-hmm. So one option could be to nominate him as a beneficiary for one of the trusts. What are your thoughts on that?
Yeah, no, I think definitely, like, you should be looking to nominate someone for as a beneficiary of the trust if they've got like a low amount of property. And so this is kind of a mathematical exercise.
Yeah, and I sort of found when I was doing the calculations that owning up to about $1 million worth of land for an individual is still quite affordable from a land tax perspective. Yep. Beyond $1 million, it gets expensive, and like beyond $1 million of land in an individual holding gets quite expensive, and that's when maybe you should consider paying the surcharge. Do you sort of think that's a fair sort of generalisation?
Yeah, that's a good generalisation.
Yeah. So if we said that we actually take this one here, this trust 2, and we give that one to the husband, which we've said here. So we've kind of said here who we're going to assign things to. So we're going to assign this one to the husband, so that will be joint with the husband. So my arrows might be starting to get a bit confusing now. But these two here, we're going to actually pay the surcharge.
Yep.
So what this actually results in, we actually end up, we've got the full scenario that's been attached to the comments, so you'll be able to see all the calculations of this. I won't go through it in too much detail because we are running very over time. But basically we're seeing that total land tax payable is, for the wife, she's going to end up paying, I'm just going to put it here, I'll put it over here. Can we still see that on the screen? Yep, so total land tax payable in 2021 for the wife is $4,948.25. I might give you the pen to.
Oh, sure. I can be helpful. Yeah, this is what I do.
For the husband, the land tax is $3,743. $43.75.
Yep.
For the trust, so the joint we've already covered. Trust one.
Mm-hmm.
Will be paying the surcharge.
Mm-hmm.
So Trust One has land.
Oh, and so I just wanted to note that on the surcharge, so Ray said, is the surcharge worth nothing if it's in a trust, or is the threshold worth nothing in a trust? It's like, no, there's still the threshold,
but the threshold's only $25,000, which means any land above $25,000 has to pay land tax.
Yes. So yeah, but in a nutshell, yes, the threshold's worth nothing. Like that's kind of
in a trust,
basically.
Unless you nominate a beneficiary.
Yes.
Yeah.
That's a really simple cut down. Sorry if the longer answer was.
The reality is, Ray, that this is very, very complicated legislation. So if it sounds complicated, that's because it is. But basically, if you choose not to nominate a beneficiary, then any land in the trust that is worth more than $25,000 will be paying land tax at the surcharge rates as per the tables that we've attached to the Facebook post.
Mm-hmm.
So getting back to this, Trust One will end up paying $2,722.
$2,722.
So this is a good example of how the trust surcharge rate works. This trust owns a combined value of $497,000 of land. So if you're looking at approximately $500,000 worth of land for a trust, you can expect to pay land tax surcharge rate of approximately $2,700, right? Then Trust 3 has not been nominated, so that's a surcharge rate. Trust 3 has a current value of $540,000 in land, so they're going to be paying a trust surcharge rate of $3,150.
Yep.
So that's $3,150 for that.
$3,150.
So unfortunately, we're not joking when we talk about the $25,000 threshold. This is now the new legislation.
Yeah.
So
looking at this example here, so the total value of property in this trust here is $497,000.
Yeah.
Okay. Now the threshold outside of a trust is $491,000. You know, so this is only
450.
450.
Yeah.
Too many numbers in my head. So this is, you know, outside of a trust, this would only be getting a little bit of tax.
Yeah.
But inside a trust, we've got that little bit of tax plus 0.5% on the entire value of the $497,000. So that's why we've got $2,700 worth of tax.
Yeah.
Now all of the rates are in the tables
we've attached to the Facebook post. So just have a look at the comments section below, Ray, and you'll be able to get all of the land tax rates, including the trust surcharge land tax rates. I want to point out one thing though, because whilst it seems unfair that this trust is going from paying no land tax to now having to pay $2,722 a year, and this one here has gone from paying only a little bit of land tax to now having to pay over $3,000 a year. I actually did the calculation to see, well, what if we actually aggregated Trust 3 with the husband as well? And I actually worked out that instead of paying $3,150 in land tax for that one, we would be paying nearly $11,000 extra in land tax if that was actually aggregated with the husband and we weren't paying the surcharge rates.
Yeah.
So the surcharge rates, you know, it would be nice if we didn't have them, but the fact that we have them means that you actually can save a lot of land tax as well, which is similar to your example that you said.
Yeah, if you have if you have lots of properties and you hold them in, and you put often works out well to hold them into different trusts and not make a nomination. Now, and let me tell you one other piece of good news is that one of the fights that taxpayers have had with the Commissioner over the last sort of 10 years in particular has been whether a trust is the same as another trust and therefore whether the Commissioner will automatically aggregate them under the old rules. Now, the good news is that now all of those rules are now gone. So if a trust is a different trust, you just pay the surcharge rate and that's it. So you can have one trustee, you can have 10 trusts under there, and a different title in each trust, and no questions asked. Now, actually, one of the things that I'm not sure about is how far you could push this. If you had for example, if you've got a car park and divided into 1,000 little car parks and had 1,000 trusts, whether the Commissioner would be happy with that, and whether he would attempt to put anti-avoidance provisions to it. I just note that that's a real example from the past.
Well, I did also read though that all land owned by the same trustee for the same trust will be aggregated together. So the question is, what will the Commissioner deem to be the same trust? And that's where if the beneficiaries are the same...
Well, no, we don't have those same trust rules. It's like as long as it's a different trust, we should be okay.
Okay,
yeah.
Cool. Excellent. We've got another question from Ray. That's serious if you only own one property. You would have been paying anyway.
Yeah, this is the bad news. Like, someone who's not there's going to be a whole bunch of people who were not paying land tax before, and suddenly they're going to be jolted into it. So let me give you one more strategy for someone, say, buying their first property.
Yeah.
Okay, and then we'll probably have to wrap it up.
Yeah.
So, although I think you got more questions.
Well, I want to talk about the relief packages in a minute.
Okay, and then
because we need to talk about that, and then what people should do for future investment purchases.
Sure. So one other thing, so the default structuring has been a discretionary trust, but just say you're going to buy your first investment property, you might not buy it in a discretionary trust anymore. What you might buy it in is a unit trust, and have the unit, say, owned by, say, the husband or the wife, and then it'll be as if they own it. And it'll be aggregated with them.
Holdings.
But what we can do is we can create a special capital protection unit trust that will add you the asset protection that you'd want, and so that what will happen is that if the husband was the person who owned the units and they're deemed to be the owner for land tax purposes, if the husband then went bankrupt, what would happen is the trust would have additional units owned by, say, the wife or a trust, something else, and then all of the value would be protected over somewhere else. So that's one method. Another method is we can have the property owned, say, in the husband's name, and the husband goes bankrupt. We make sure that the property has a second mortgage that's registered for the benefit of a trust. And so there is a few other types of asset protection that we can do but while the government's implemented this, they've only thought about land tax and thought that all these structures exist for land tax, but really they exist for land tax is way down the list. You've got to think of income tax, asset protection, succession planning, capital gains tax, and then
it's just because land tax is topical at the moment because of the changes.
Yeah. So there are structures that you can use going forwards, and so
I guess the key to that is that
you need to think through
you don't stop investing in property in SA.
Correct.
SA still presents great investment opportunities. We've got really great rental returns, great capital growth projections. Expected for SA in the coming years. So don't let this put you off investing in property in SA. It's just that you have to be smart and get the right advice about your ownership structure before you actually buy the properties. So moving forward, I hope this doesn't put people off from investing in SA, because there is still great investment opportunities, and the land tax, is manageable. It's just a matter of making sure that you are proactive with how you manage the ownership structures moving forward.
And where things have been bad has been that they made these big announcements and there was a lot of fear as to what would happen. Fear of the unknown. Yeah. And that's the worst thing. And that's why I was saying that they introduced this in a terrible way. Because the last thing you want to say is we're going to introduce this, but we're not going to, it took them months to show us what the actual legislation was.
The reality is a lot better than what we were afraid of.
We've managed to ameliorate
hopefully that has alleviated some of your concerns. I want to quickly touch on the relief compensation packages that are available. Because I believe for individuals, they are able to get relief. So for the first example that we showed, you are entitled to relief from the compensation package if your land tax bill is increasing by more than $2,500, and your relief will be equivalent to 50% of the increase in land tax for 2021, 30% for 22, and 15% for the year 23. So that's something to take advantage of. Are you aware at this point of how people can apply for that relief? Or is too early to tell?
Yeah, it's too early. It said that it's going to be in March that you can start applying for. So, Revenue SA's got a lot of administrative work to do.
Yeah, and it's also important to point out that you can't apply for the relief for additional tax paid for the trust surcharge. So if you choose to pay the trust surcharge rate on the trust, then you don't get the relief. But if you choose to nominate the beneficiary as an individual, then you can potentially apply for some compensation relief. And I guess the good thing about this compensation relief package over 3 years is that hopefully it will stop you from doing a fire sale and rushing to sell your property unnecessarily, because it will give you time to really plan out what's best for your long-term future. So I'm really glad that they've introduced this compensation package.
Yep. Well, what we should do is going forwards, what they should start the tax reform and do some proper tax reform that they started a few years back. Now, getting rid of stamp duty on commercial property, that's massive. That's fantastically efficient for everyone involved. And so, what we need to do is why don't you lobby the government to get rid of stamp duty on residential property too?
That would be nice. But there is also some compensation relief packages for developers, and I think you touched on that before. Do you want to just quickly explain what that is?
No, I'll let you do that one.
Okay, let me do that one. So developers are actually able to get a relief or compensation package for vacant land that they own for affordable housing. So in order to be eligible for this, its relief is provided for a limited 12-month period, and it's going to be conditional on developers entering into agreement with the South Australian Housing Authority, with the developer agreeing to meet any requisites for affordable housing requirements. So that's something that you can apply for if you own some vacant land for affordable housing. There also is a pilot program that the government is trialling for affordable housing in general, where owners enter into an agreement with a registered community housing provider to make their property available to tenants for 75% of the current market rate. So if you do have some properties that you're happy to make affordable housing properties on this program, you may also be eligible for additional relief and compensation. So that is that. Ray has said, is it time to leave SA? Can you change ownership out of a trust? Well, I don't think it's time to leave SA, Ray. Please try and support SA. We need more people supporting SA. In terms of can you change ownership out of a trust?
Actually, what you could do is you could distribute the property from the trust to you individually without paying stamp duty, and then you won't pay the trust surcharge rate. So I think that's probably Ray's answer.
But you can also achieve the same thing by just nominating an individual.
You could nominate an individual, sure.
Land tax. So you can change ownership out of a trust, but you can also just nominate an individual, which would have the same same outcome.
Actually, South Australia has like it's a place that we go internationally, come to South Australia to set up trusts, because our trusts can last forever, whereas you can only last for 80 years in interstate, and in other jurisdictions you have to depend on how long the Queen lives.
Yeah. Now, I did have another question come through from Trevor about future ownership structures. He said, as a result of land tax aggregation, if one held close to $755,000 in total site value, going forward, would a good strategy be to purchase one or two subsequent SA properties within a discretionary trust and withhold naming beneficiaries to reduce the land tax rate from 1% in 2022 to 125 plus 0.5%?
Yep.
Effectively paying the surcharge rate.
Yep.
I think that we've covered that already.
I think so, yeah.
That definitely, once an individual gets above that sort of $750, $1 million mark of land holdings, then you're probably better off paying the trust surcharge rate. As we saw here, the difference between $11,000 and $3,000 a year. So definitely that is... and I think we've well and truly run out of time. We've gone over time. Sorry to keep you, Adrian, but I think it's been a really good discussion. We've covered a lot of content today. If you want some more information on this, there are a few places you can go. So Revenue SA now have a lot of information on their website about it. It's called revenuesa.sa.gov.au/land tax changes. They've also got a land tax hotline, 8226 3750. You can also email them at landtax@sa.gov.au. But we're also available to help you at Rise High Financial Solutions.
Mm-hmm.
Adrian's been kind enough to offer assistance to our clients and our supporters as well. So Adrian Cartland is also available to talk to as well. And we just want you to know that it's going to be okay. And there are things that you can do. Don't put your head in the sand. Don't get angry. Just be proactive in finding solutions as to how you can move forward and keep your properties, or be strategic about what you do with your properties moving forward, and be strategic about your future investments in SA. So hopefully that's given you some guidance and some comfort around those things. If you've liked our segment today, please subscribe to our YouTube channel, Rise High TV, where you can get always constant updates on anything money, property and finance related. Thanks again for tuning in today, and we hope that you have a great Christmas, great Happy New Year,
Merry Christmas.
and thank you so much for tuning in. Bye for now. Bye.